Hi, welcome to another video where we're going to review the cash flow statement. We're going to go through an analogy that will hopefully help with some intuition about understanding the specific parts of the cash flow statement. And then we'll have a few other videos that dive a little bit deeper into the parts of the cash flow statement. Summary from last time, the only thing we track on the cash flow statement is cash, period. That's it. That's the only thing. If a transaction doesn't have cash involved, we're not concerned with it. It's cash. If cash is being traded and put into an account or taken out of account, that's what we're tracking in the cash flow statement. And there's three types of transactions. There's operating transactions, investing transactions, and financing transactions. So we calculate in the cash flow statement those three parts: operating cash flow, investing cash flow, and financing cash flow. So I like to use an analogy to describe what the cash flow statement is. Cash is the blood of a business. You can go out of business. You could have growing sales, selling a lot, and have huge growth and still go bankrupt because you don't have enough cash. Cash is so crucial to a business that we have an entire financial statement dedicated to it. And so I use the analogy of cash being kind of like the blood in your body. And I think it overlays pretty well with the three different financial statements. So bear with me on this analogy for you. If we think about a healthy body, there are a few signs of a healthy body that we could have. For example, we might not run out of breath, right? When we run, we don't, if you go up a couple flights of stairs, you're not tired.
From? The elevator just broke. I had to walk up 5 flights.
And you got the AIDS walk tomorrow. You're never gonna make it. You're in horrible shape.
Hey, I'm in tip-top shape.
Tip-top?
Hey, better than you.
You don't horizontal run.
Yes, Chloe, nice. Amy, what are you doing?
I'm doing horizontal running.
Horizontal running.
And endurance is probably the key focus. So when you think about a healthy individual with a healthy body, they are usually an individual that has a lot of changeover in their blood, and their blood has been circulating a lot of activity and flow with blood in their body is how we recognize somebody with a healthy body and having healthy blood. When it comes to healthy businesses, it's similar to this. How we measure a healthy business is one that is peeling off a lot of cash, one that has high cash flow related to the operations of the business. A lot of times that's measured out in the industry with something called EBITDA, earnings before interest, depreciation, amortization, and taxes. This profit, this margin that you have from the business is a sign of a healthy business, a sign of a business that doesn't have a lot of extra fat when it comes to costs. It is healthy, it's trim, it's actually just peeling off good profit, and it's consistent. That's the sign of a healthy operating activities, and a healthy body are very similar in that way. And if we think about investing activities for our body, say we have, our operations, our body is having poor circulation, something goes wrong. There's different activities that we can do related to that. We can work out to try to improve ourselves. That might include punching meat like Rocky. It could include doing Van Damme splits like.
What you see is a body crafted to perfection. A pair of legs engineered to defy the laws of physics, and a mindset to master the most epic of splits.
Who can say where the road goes, where the day flows, only time? And who can say if your love grows as your heart shows, only
Most epic of splits. Getting the Van Damme splits going. It could be putting on a Yoda pack. All right, you get a little Yoda pack on your back and you walk around. That can you can burn some pounds that way, increase your blood flow. Eating better. All right, balance iron levels. If you eat better, supposedly that helps your blood and helps with the quality of blood that you have. And when you think about the investing activities of business, you can buy and sell a machine, invest in new factories, upgrade equipment, enhance certain things so that you maybe operate a little bit more efficiently. All of these components are related to investing in your body or investing in your business to make the operations better. All right. And when it comes to investing activities, remember, it doesn't have to be a one direction cash flow. If you have a machine that you sell, that would be a cash inflow. If you have a machine that you buy, it's a cash outflow. Doesn't matter if it's the machine is being bought or sold because it's used and old and you don't need it, or you're buying a new one. We track all of the cash flows related to it. Staying with the body analogy, people get sick and need blood. What do? They need a blood transfusion. I have no idea who this woman is, by the way. I just found her online, but she just had a kid. Maybe she needed a blood transfusion to help supplement the blood she had. Her operations were not, her body was not up to speed with the blood flow and getting enough blood to sustain it. So she needed to get a transfusion. This frequently happens in emergencies, car accidents, that type of thing. And that's when outside blood, somebody else's blood, comes into your body. I relate this to financing activities because sometimes businesses get sick and they need outside cash as an infusion of capital to invest in the future to fix their operations. They often need that to build their operations, an outside investment to just build. How this relates to the body analogy is getting a blood and blood transfusion or donating blood. Kind of give back to the community or pay it forward so that when you need blood, there's blood out. In the business, we call this financing activities. This is anything that we do where we sell equity, sell debt, or we buy back equity, or we pay back debt. All right. So it's either one. These are the financing activities. They're very similar to this blood transfusion. You sell equity or you receive a loan from the bank so that you can fix your operations and improve your operation. So why the cash flow statement? The cash is the blood of the business. It tells us a bit more than just what accruals tells us. Cash flow statement's linked to the income statement. It's also linked to the balance sheet. So it has this nice nexus where we're able to actually know a lot of what's going on in the business. In this class, we're going to have you construct a cash flow statement using only your income statement and the balance sheet. It's going to be pretty awesome. Also, the cash flow statement informs us of our cash levels and the sources and uses, where they're coming from and where we're spending our cash. And that's really important because if our operations are high in cash flow, then we have a very healthy business and we can look at how we might pay back our debts or our equity holders and invest in the future. If we are getting most of our capital from the other two and not our operations, we need to make sure we have our head on straight for what is the plan for the future and how the operations will improve. As a reminder, there's 3 components to the cash flow statement: operating, investing, and finance. In summary, the only thing we track on the cash flow statement is cash. Cash is the blood of the business. It's a super important financial statement. We track operating cash flow, investing cash flow, and financing cash flow. And one of the things that's great about this, as far as the financial statement goes, it's pretty easy to audit and track. You just check the account and see if transactions actually happened. Auditors come in, they look at the transactions, they sample a few and make sure they all sync up and that the balances match up. So that's kind of the neat thing about cash, is that it's very easy to audit. You can manipulate accruals. You can make up assumptions about what you think a value is, when you're going to collect revenue, things like that. But when it comes to cash, the rubber hits the road. There's no assumptions. You either have the cash or you didn't. The transaction happened with cash or it didn't. It's there. So that's cash flow statement.